not sure which one of these clocks are correct. Does anybody have a, what does your phone say?
558.
5:58, so these clocks are a little slow. So we're gonna get going. Okay. They're gonna have a little bit. Okay, we're gonna start on chapter 6, page 169, and alternative minimum tax. First, alternative minimum, the new tax law changed, and they did away with alternative minimum tax for corporations. That should probably be in the corporation part. We turn over to 170, and you'll see how do they work alternative minimum tax. Okay, so what is alternative minimum tax? You figure your taxes the normal way on our tax return, the 1040, and alternative minimum tax is a completely different tax system. Okay, and you take the normal tax on that income, the alternative minimum tax, and if alternative minimum tax is higher, the difference is called the alternative minimum tax. So, in this case, I put one up here just to make it easy beforehand. So, alternative minimum tax goes like this. Normal, on your tax return, you get all your total income minus your adjustments. That's what we did last week. Okay? That gives you adjusted gross income. Right now, we're going to subtract for a married couple. You'd subtract standard deduction of $24,000, and if you don't have anything else, you would get to your taxable income. You'd either look in the book, or your computer would do it for you in reality, and it would give you the amount of tax. Okay. Then, in this case, I had $200,000 of taxable income. I looked up the tax, $36,579. Okay? So, we're going to see what it would be. Alternative minimum tax, you start with the same $200,000, and you have all kinds of adjustments. You can look through this, and a lot of this is pretty obscure. They're not going to give you a hard problem with a lot of these really hard adjustments in there. But they might give you a simple one. Okay? So the way the alternative minimum tax works, you start with the taxable income, you add or subtract the different adjustments. You would add back standard deduction, $24,000, so your income goes up to $224,000. I just used that one as the example. I didn't get to the exotic stuff. Then from that, you get on here, if you're single, you get to subtract a one-time exemption amount of $70,300. Married couple, $109,400. These are big changes from before. The numbers were a lot smaller last year and the years before. Hello, come on in. I can't, where's your buddy?
Oh, she's coming.
Okay.
I
You can sit, it doesn't matter. They,
prefer she's got food here.
huh?
I can move back here.
Oh,
That way
well,
she can-
or let them both sit on that side,
Yeah.
you sit on this side.
I'll still-
Okay, you sit over
Now I
there,
can
wherever you guys want. I
sit
don't
straight.
care.
Feel like I'm being punished on that corner.
Well, you got a better view from right there. Okay, so what I was just showing you, you get an exemption amount. Single head of household would be $70,000. Married family joint, $109,000. So, after you make the adjustments to the taxable income, then you get to subtract this big amount. In that case, it would be $109,000 for a married couple, so their taxable, their income that they are using would be $114,600. Why that's a big deal is because they only have two tax rates on alternative minimum tax, 26%, 28%. If you'll look, the first $191,000 is 26%. So you gotta have big incomes now. Okay, in the past, it wasn't near this big. So, in this case, on this 114,000, so you're at 26%, 26% of 114,000, your alternative minimum tax would be 29,796. It's smaller than this 36,000. So in this case, you wouldn't have any alternative minimum tax. And that's on 200 grand. Okay, so you'd have to have a lot of write-offs. In the past, first, those numbers, the exemptions were half as much. But in the past, you get to have an exemption for every one of your kids. So a guy with 4 kids, okay, a guy with 10 kids, 8 kids, a husband and wife, they had an exemption of $4,000 per each, more or less. That's $40,000. So if they had an income of $80,000 and they have exemptions of $40,000, standard deduction, itemized deduction number 20, well, they hardly paid any taxes. They used to get hit with alternative minimum tax. Okay, now it's all changed. That was one of the new tax changes. You got to be really rich now to get hit. Well, okay, so, but let's say that you were, and your alternative minimum tax was 50 grand, and your regular tax was 47. The alternative minimum tax is the difference in the three. So it would be, this would be your alternative minimum tax. And what it does, it adds to your normal tax and brings your normal tax up to the minimum, the alternative minimum tax. So you'd have to pay no matter what. So in the old days, we would try to write off more stuff, Schedule A stuff. It wouldn't do you any good, because after you got up to here, you could write off more money, but it just made the alternative minimum tax go up, so it didn't help you a lot. Okay, you're probably, so let's go see what kind of questions you're gonna get. They're probably gonna, if they're gonna ask you anything, what are they call them tax preferences. There's a list of them here. There's a lot of them. The biggest one used to be depreciation. Now I don't see depreciation on the list, because I think the bonus depreciation is 100%, and I think it's also there for alternative minimum tax as it used to be. Hello, come on in and make yourself at home. Okay. Standard deduction, we've already told you that if you're using alternative minimum tax, you don't get to write off the standard deduction. Another thing you can't write off are your state taxes. Okay? I was really upset. One year I actually sold a company and paid a lot of state taxes. And I was waiting till the next year, and I was gonna get to deduct all my state taxes. Well, then I did it, and it didn't give me any bang for the buck, and I would go, wait, what's wrong with the stupid computer? And it kept giving me alternative minimum tax. Every time I'd raise the number, it would come back and it stayed the same. Then finally I looked in the book, found out I was not gonna get it. All right, so standard deduction, taxes, tax exempt interest, home equity refinancing. These are certain. Hello. Get in. Okay, hold on. You just got my eraser. Oh, no. Okay. Who's missing? Whoever it is probably going to get to sit right there. Okay. 1, 2, 3, 4, 5, 6, 7, 8, 9. Riego?
She usually sits in.
Huh?
She usually sits here.
Okay, that's who's missing. All right. Does everybody have a general idea about alternative minimum tax now? Questions, any? Are you gonna have hard questions? You're not gonna get hard questions. You're gonna have to know what are preferential items. Okay? For sure, standard deduction is gonna be one. Taxes, if you itemize, you're not gonna be able to write off taxes, and you're not gonna be able to write off, you didn't used to be able to write off, non-reimbursed business expenses subject to 2%. You don't get those anyway, but that was one of them. Okay? Minimum tax credit. So, if you had alternative minimum tax, you get to have alternative minimum tax credit if in the next years your alternative minimum tax is lower than your actual tax, you'll get a credit. It's because the numbers have gotten so high, you're not gonna get much of that anymore. But if somebody goes, what is the minimum tax credit? Okay. Basically just, okay. That's enough of alternative minimum taxes for a while. Employee taxes and withholding, Social Security. So, an employer must pay 6.2% of your wages, and you must have taken out of your pay 6.2%, going up to $128,004. That number you probably need to know. Also the 6.2%. You also pay 1.45 of all wages for Medicare, and the company pays 1.45. That goes, there is no limit. So if you go over 128,000, your Social Security goes away, but your Medicare keeps going forever. Everybody got that? So if you have one company and they withhold too much, Bay and I were talking about before class, what do? Well, you have to go back to that company and they have to give you back that money. On the other hand, if you work for more than one company, let's just say two to make it easy on me, and you made $150,000, well, you only have to pay Social Security on $128,400. So when you file your taxes, you'll get back the excess. And in my case, usually it's my computer that catches it, not me so much. Hopefully the same for you guys. But if not, can you go back to your employer and get it? No, your employer did the right thing. You're getting it back from the IRS. Okay, anything special about that? Household employees, if you have a household employee and you pay them more than $2,100, you gotta start taking out taxes. It's gonna be on a Schedule H. Additional Medicare tax. Okay, so what is that? Instead of just paying the 1.45 and the company paying the 1.45, you gotta pay an extra 0.9. If your income is over on the bottom of page 174, married couples over 250,000, surviving everybody else 200, except for married filing separately. Okay. The employer has to start taking out that 9.1%. A little bit less than 1%. If you hit over 200,000, so everybody, are they gonna ask some of this stuff? This is pretty, they're not usually asking it, but they will not have one question on this. And usually it's the 250 or 200, what are the limits? And so you have somebody, let's just say single. So a single person makes 230,000, and so you gotta have, so 30,000 times 0.9. It's either 270 or 2,700. I can't do that in my head. Does everyone understand? So you'd be $30,000 over the 200. So $30,000 times. Oh, I guess I can do it. Yep. So 3. $270. Does that sound about right to you guys?
2,700.
2,700 would be what?
0.9.
What would the 2,700 be?
Okay,
270.
on page 174.
Oh,
Wait,
I don't
yeah,
have it here.
Well, then you're not gonna be able.
Tell you something.
You don't have a book?
0.9%.
I have
It's
a
the
book at
excess of
home.
money.
Oh, okay.
Okay.
Bring it next time.
Yeah. You're gonna-
Excess of Medicare.
Huh?
The
There
excess of Medicare.
is a graph of this, so
It's called additional Medicare tax.
Okay.
And, so when we said, now, what happens if you could still have, $250,000 if you're married and each of you had, one person had 150 and one person had 100? Well, they would add up to 250, but each of them would be less than 200, so there would not be any withholding. You still gotta pay the tax on it. The net tax, net investment income tax, the same $250,000 on page 176. If you go over $250,000 for a married couple, 200 for a single, you've gotta pay the net tax, net investment tax, right? And it doesn't apply to non-resident aliens. They're not gonna have a lot about any of this stuff. They might have one question per this, and you might not be the one. One or two people in here will get that question about net tax. One or two people will get that about the additional Medicare tax. And maybe one or two people get something about alternative minimum tax. Okay? Self-employment tax, everybody pretty much is how that works. If you have, if you make under $400 of self-employment income, you don't have to pay any self-employment. If you make $400 or more, you gotta pay self-employment tax. Okay, and so what does that come out to? About 15.3. And you gotta know this trick. So let's say you had $10,000 of self-employment income. To calculate the self-employment tax, you would say, you'd multiply it times 92.35%. It's in your book. And so you'd get 92.35. Okay? And if your income was under the 124,000, you could do the shortcut of do the 15.3%, and it would give you the right answer. Okay? If you made over 124,000, whatever it is, 128,400, then you stop at the 128,400 for the self-employment tax, and you only go over for the 2.9 Medicare tax. Does everybody see how that works? I've been caught before with that one on the practice problems. I keep forgetting this 92.35 before you do the calculation. Because what it really means is, here's what you're supposed to be doing. It says 10,000 minus 7.65 is what if you take that, that's really the same as saying 92.35. So you shortcut and do 92.35 times this, and then you multiply it times the 15.3.
15.3 is what?
Huh?
15.3 is.
Self-employment tax. Yeah. You're gonna have difficulty today without a book. Everything that we're doing is based on what's on the page in the book. Maybe you ought to come sit right here. Except that's not gonna work very well because I'll be getting up and down all the time.
And isn't that on?
Yes, this is on. And what this is we have, say, hi, Lisa. We have somebody on the Big Island that's sitting into the class. And so we move this over here so she can actually see this
Oh, okay.
and hear me. And then we're also making, we're recording this whole class so that if any of you guys missed this class, you can actually call Sam during the week. He will give you a copy or let you download this off the internet. And so you can sit here and listen to us again.
He did one for another.
What's that?
He sent email with the recording, so.
To you?
Yeah.
Oh.
What was the last?
Did it work?
Was the last class recorded
The
too?
other class, yeah,
Yeah.
I think, was,
So if you weren't here, you can call and ask and get them to sit
She
it to
said
you.
one, like she said, but that was just I think the second class, the same class we missed, but.
Okay. So, clergy also have to pay self-employment tax. On a clergy's W-2, they don't take out Social Security and Medicare. So their W-2 might say, we'll just use the $10,000 again. And they'll have withholding of 1,000, optional. But then on lines 3 and 5, they'll be blank and they won't have any self-employment tax taken out. The clergy have to pay their own self-employment tax. And there's some exceptions. If you take a vow of poverty, you don't have to pay it. If you opt out of Social Security, you don't have to pay it. What does that mean? When the preacher gets old, he's gonna depend on his church to keep him alive.
or savings.
Or savings. Okay, so on their W-2, they don't have any Social Security, Medicare taxes taken out. So what happens to those guys? If they make $10,000, they have to figure their self-employment tax on that $10,000. What happens if they also get an allowance for a room, for their little cottage and their utilities? We'll just say they get an allowance of $10,000. We'll say $5,000. This is really, wouldn't apply to Hawaii very well. Okay, but let's just say the minister got $5,000 allowance for his little one-bedroom apartment. That's not taxable. Your housing for a minister is not taxable as income. So he'd pay income tax on the $10,000. The $5,000 for his housing, he doesn't pay any income tax, but he has to pay self-employment tax. So you'd take this number plus this number, it would be 15. Then you'd multiply it times the 92.35%. Then you'd, whatever that number came out to, which is really close to 14,000 and something. And then you'd multiply that times the 15.3. Everybody see how that's gonna work? Or are you gonna have any complex? One year they had a problem, but it was a simple one. It wasn't for a minister. You know, they go, somebody had $10,000, we'll say, of self-employment income. How much is their self-employment tax? And the key that you have to remember is the 92.35 and then multiply it times 15.3. Oh, everybody good, so kinda got this? Hopefully this stuff you already know to it as partially, or doing well, all of this stuff we're talking about, in reality, your computer does it for you nowadays. I haven't done this by hand in a long time, 20 years, 30 years, some number like that. So we've already gone over this. Sometimes the clergy doesn't have to worry about doing Social Security. Unemployment FUTA tax, when is it? It's on the first 7,000 of income. And when do you have to do that? If you have an employee that makes over 1,500 for any quarter?
Did this question come up?
Not really. These questions, they got a lot more detail. All you do is then read it and then kind of just know it for the test. They're not gonna ask you pretty much. They could, but they don't. When do you have to use a household employee? If you told, for any one employee, your total cash wages is more than $1,000 a quarter. For all the employees, any one employee, you pay them more than $2,100 for the year. Will they ask those kind of questions? I don't know. I don't think so. I would never remember that stuff except for reading it here. So the good news is you read it here and you might remember it a month from now for the test. After that, by this time next year, I'll have to relearn it again myself. I can barely remember it in time for the questions at the end of the chapter, much less a month from now. They don't usually play gotcha. There'll be just a few. This book does it more so than other books. They've even asked questions that have to do with corporations. In this form, we're not even in corporations. Okay. Penalties. We're not going to really go over a lot on the penalties. The farm option method, they've never asked that stuff. But you can read it just in case. Individual shared responsibility tax. Does everybody understand about Obamacare and the rules? This is the last year there's any penalty. I don't think they're gonna go a lot. They didn't do a lot in the past. What do you need to know? You're supposed to have Medicare, you're supposed to have health insurance. And in this book, they call it PPACA. Most people call Affordable Care Act or Obamacare. The IRS would call it Affordable Care Act. There are some exceptions down here on the bottom of 179. One of them is the short gap. We face this one. Every now and then you get somebody that comes in, and hopefully you guys look when they show you those 1095 A, B, or C, and if they come up and they go, and you see on there that they have 3 or 4 months missing, you go, did you have any other medical? Or if not, you need to go fill out the little, in your software that says how many months they were covered. And if they were only covered 8 months, there's a little bit of penalty on there, okay? One of the questions might be, how much can it be? And it's, the maximum I believe is $695 a person. For a whole family, it looks like $2,085. The $695 they might have asked once. I didn't remember the $2,085 number. There's a lot of reasons on 179 why you don't have to have coverage. If you were an illegal alien in Texas and you worked all year, you're an illegal alien for immigration, but you're you're legally here for taxes. You have to pay taxes because you were here for more than 183 days, right? So you have to pay taxes. I don't know how they filled out their tax return.
Without a social.
Huh?
Without a social.
They have a social. And I've gone through, every year I get at least a half a dozen people that their social security number's been used by somebody else. One guy, he happened to have a Spanish name, and he grew up in San Diego. And somebody else has his exact same name and social security number. They live in California. And so, one year they wouldn't give him his tax return. It took 9 months. I had to go to the taxpayer advocate, fight. Finally, we got him his money and proved that he lived here and this other money wasn't his. Somebody was working account. The next year, that same person filed for ACA, Obamacare, and so this guy works for the union here. He was a foreman. He's got full insurance, everything. But it took us 9 months to get him his refund for the same. They go, no, you got Obamacare. He goes, no, I didn't. Yes, you did. And the guy, it was like, so we got the taxpayer advocate. We had to send in everything in the possible world to prove he lived in Hawaii. He's married. They got kids. They live out. They own a house on Hawaiian homelands. His wife is Hawaiian. It was horrible. And we're probably going to go through this again. I've gone through it 2 years now with the guy. Somebody has the same name, same social security number, and a job in construction.
They still haven't found a person?
Huh?
They still haven't found a person?
It's hard.
They don't go look for the person. The IRS doesn't.
Yeah.
They don't have,
We have
you might call the White House and ask them, hey, go look for this guy. He may not, but for all I know, this guy here may be the wrong one. But he is definitely not in California. And I actually found out the company that he was working for because I pulled a transcript and told him to go to this company and go find this. IRS wouldn't do it. They go, no, we're not doing that stuff. That's not their job.
I mean, they can hire somebody, save some money here.
We have so much identity theft that.
Yeah,
There's
that's
so
not
much
even
money,
close.
There's so much education credit that was given, first time home buyer credit that was given to wrong people, and it's been a problem for years.
I had another Delta airline pilot makes big bucks. Same thing happened to him. Somebody in California filed a tax return with his name and social security number. He's not as happy about that. But he got it straightened out. Okay. Home buyer credit, that's what you were just talking about. So back in 2008, for 1 year, they had a home buyer credit, and it was up to $7,500, and you got the $7,500 to buy a home. Remember, that's when the whole economy was falling apart. And that first year, then you had to pay it back over 15 years, $500 a year. Right now, I have this happen at least once or twice. Every year, somebody forgets to put it on their tax return, and it gets rejected and go, oh, you got a home buyer credit. And so we go back and they go, oh yeah, I forgot. But anyway, the IRS computer doesn't forget. So, the following years after that, you still got that same credit, but it's not refundable. You stay in the house for, I think, 3 years or more, and then you're forgiven, you're good.
Right after the other one.
Yeah, but the first guys that did it the first year are stuck for 15 years. So 8 and 15 is about 23. Okay, F-bar, we talked about it in one of the chapters. They've got some more in here. I just wanted to show you. So the F-bar, you have to file if you have more than $10,000 in a foreign bank account. Got any class like that? Okay, so, and you do this, you can only do it online, you can only do it on a computer. And so if you don't file, the civil penalty is not to exceed $12,450. $12,000 is the penalty. If you do it willfully, it's $124,000. That's a bunch of money. Or up to 50% of the balance that you're hiding. So if you're a drug lord, you might get fined a bunch of money. Or you're a politician. Either one of those. Specified foreign financial assets, that's the other form that goes with this. The first form, F bar, is not part of the tax return. But the other one is called Form 8938. We talked about this already, but the same thing applies. So there is a $10,000 penalty for failure to file the form. Guess what? You're on the tax return, preparing the tax return. If you don't ask your clients, do you have more than $10,000 in a foreign bank account? You could be liable for a penalty on this. If you don't ask and they have this and they get fined $10,000, they may hire a lawyer and come after you. The kind of people they may or they may not. But okay, so it can be an additional $10,000 will be accessed every 30 days. So they tell you, oh, by the way, you got to file this, and you just ignore them, keep ignoring them. It can go up to $50,000. So okay, does that help you guys? We've already talked about it, but I don't know the questions they're going to have. But last year, they had a lot more about this than they'd ever had before. So that's just a heads up. Everybody that took the test had something about F bar or the 8938. That was different. We'd never had that before. Okay, tax credit. So now we're going to go to the stuff that you guys should already know. Hopefully you'll know all this. Foreign tax credit. Okay, what is that? You get a dividend statement, and on there somewhere you may have $10, $20, $30, $50 of, you've got a mutual fund that has money invested in companies all over the world, and some of those companies are invested in foreign companies, and they pay foreign taxes. Well, you get to take those foreign taxes that they pay, you can write them off as a foreign tax credit on 1116, or you can put them on a Schedule A as a deduction. It's usually better to use the foreign tax credit. There's a special rule. If you're single, you can have up to $300 of foreign taxes, put it on, I guess it's now Form 3, line 48 or something like that. And you get to take off up to $300 without doing the 1116 form. If you're a married couple, that's $600. I hope they always keep it under those limits, because it's a bunch of humbug to fill out the 1116 comparatively. The 1116 is for the foreign credit. Okay, how does this? And there's also, while I'm here, maybe it's on the next page. There we go. Foreign source, taxable income, worldwide income. Okay. So let's say your foreign source income is 50 grand, and just to make it simple for me, your total income is 100 grand. Okay? So basically that means 50%. And your taxes are $14,000. So 50% is $7,000. So you get to take the lower between $7,000 and the actual foreign taxes you paid. So if you paid $8,000 in foreign taxes, you could only have $7,000. If you had $5,000 in foreign taxes, you can only have $5,000. It's lower than the $7,000.
What do you mean you can only have?
Okay, so if you pay taxes to another country, okay, and you paid $5,000 in taxes, you get a foreign tax credit.
Okay.
If your income was $50,000 was foreign income, and your total income was 100, that's limited to 50%. Your total taxes were $14,000. Okay, this is your income tax, 14,000. Then you'd only be able to, your limit is 7,000, so you'd take the lower of the amount of taxes that you paid to the foreign country, or this number.
So the 14,000 is the foreign
That's your
tax-
total income tax.
income tax to the United States?
Yes.
Okay.
And either 8 or 5 is what you pay to the other countries. Okay? What does that do for you? So if I paid $14,000 and I paid $5,000 to another country, I get to subtract that $5,000 and I save that, so I don't have to pay $4,000, $14,000 and $5,000. That's a big deal. That's like, you don't want to have to double dip, pay twice. Okay. What else? You get to carry that over. I didn't know you could carry it forward for 10 years and back one. I didn't even know about the back one. I've always just carried it forward.
We don't actually have much that's like so that's, I mean, for us.
Yeah,
You know,
I don't either. I don't have anybody in the
much,
thousands.
that much.
Almost all of my clients have less than 600 for a married couple. I had one person that it was like 310, and it was gonna charge her $15 to do the 1116, and I go, you're better off just not, we'll just stop at 300. You're not supposed to do that, but I did it once. Do you understand?
Yeah, I had a question, but I forgot what it was.
Okay. Anybody else have any? Okay, so now we come to all the fun credits. These are the things that are the bread and the butter, probably for most of your tax returns. Does anybody here not do individual or aren't planning on ever doing individual? So all these next credits are for the average person. Child independent care credit. You have a child under the age of 13, or you have a spouse or a dependent that cannot care for themselves. Either way, you need somebody to take care of them. So if you have a 4-year-old child and you have to put them in child care of some sort because you've got to go to work, okay, you get a child independent care credit. But remember that it has to be for you to go to work. You can't put your child in a child care if you're at home all day and you don't go to work. You go to work as a bartender at night.
Not as
The-
much.
huh?
Yeah, full-time student.
Yeah, full-time student counts. Okay, so, or, here's some exceptions. So the point I'm trying to get is, the reason you're putting your child in child care is so you can go to work. Okay? What happens if you're a married couple and one of you goes to work and the other is a full-time student? Then they get, if they are working every month, they get up to $3,000 for the first child. If you had 2 children, it'd be $6,000. Think of it as $250 a month. So if you were only going to school 8 months, that would be $2,000, and you only have 1 kid.
Say that again?
Okay, so if you're going to school as a full-time student, you're normally, one of the limitations is your income. You have to have earned income of more than the child care that you're writing off. So if you're a full-time student, you're not earning income, you're going to school. So, and you had just 1 child. If you think about 250 times 12, that's $3,000. $3,000 is also the limit on what you can write off for a child. So if I spent $8,000 for my child care, I can only write off $3,000. Okay, and then
To get
what's
the maximum credit.
to get the maximum credit? Then you would multiply it there's a scale in here, it may not be in your book, but in the form that says if your income is between a certain level, you get a 35%. Say you made $10, $12, $1,000 a year, you can get 35%. If your income is up a higher percent, let's say your income is $50,000, well, that area, you only get 20%
Of child tax credit.
of the amount you spent, up to
You can-
$3,000.
Of the
So
amount
if
you
it's
spent.
$3,000 times, $3,000 times 20% would be $600. Okay? Child tax credit is a non-refundable credit. If you have 2 children, you'd get double that, or 6,000, even if you paid higher than 6,000. Does anybody here have young kids? Can anybody get $250 a month for childcare? No.
Oh, hey, not here.
It's been a long time that I had to do all that once upon a time. And I had 3 kids all in the same, right in the same, I had twins.
Oh,
And then one older by 2 years. So we had to traipse every day to the child care people. This is a lady that lived in Waikiki that took in children, but I don't, even then, I don't think we stayed, there was no 250. There was no 500. But, okay, never mind. Okay, so, one is you have to have a child under the age of 13. There's a bunch of other rules that go with it, or you have to have a spouse or a dependent. So let's say that you have your niece or nephew that's your dependent that's deficient in some way. Or let's just say they had a car wreck and they have to be taken care of. They broke their back and they're really have to be taken care of. So, or your parents could work also. A dependent care, any of those people. Okay? So, what else do they have to do? To be a qualifying person?
If they're handicapped as well,
Yep.
it can be over 13 years old if they qualify as.
To be over, yeah, they gotta be handicapped or something if they're over 13. Any child under the age of 13, but what expenses? Well, you don't get to write off going to school. So if you put your kid in Punahou, you can't be writing off Punahou. But before kindergarten, your kid is 2, 3, 4. I guess kindergarten starts at 5. You had him in Punahou, if they have something like that. Well, then you could write off up to $3,000 of child care. Of course, I bet you they're a little more expensive than $3,000 a year. Okay, one of the things, let's see, is that you get to write off household services, such as babysitting, housekeeping, and nursery for your child or for your dependent person. You get to write off outside services, such as daycare, the cost of sending a child to school, if the child is below kindergarten, payments to a relative for the care of a qualified child, as long as it's not your child under the age of 19 or somebody you can claim an exemption for. If you claim your parents, let's just say your mom lives with you and she doesn't work and she just stays home and takes care of your kid, she's your dependent, you can't claim her. You can't give her child care. And then you write off the child care. Okay, what expenses can you not write off? Taking your kid to and from school, or child care, or wherever. Is that all? Other than that, that's pretty much all the kind of questions they're gonna get you on child independent care. Education credit, what kind? We're down to 2 credits now. They did away with tuition fees credit. So the 2 are lifetime learning and American Opportunities credit. Let's hit American Opportunities. That's the big gorilla in the room. Why? Because you get more money. So if you have just $4,000 of tuition fees, even including books, you can write off $2,500. Okay, the first $1,500 of it is non-refundable. You don't owe any taxes, you don't get it. The last $1,000 or 40% you get is refundable. Is everybody pretty much, have you seen this before? Hopefully this is easy. When do you get this credit? Well, you gotta be at least a half-time student. You have to be in your first 4 years of college. You can't be a druggie. Oh, that's not exactly it. You can't have a drug conviction. You can do all the drugs you want, you just can't get caught. Okay, and it's the year you pay the expenses. I got caught in this one year. So, your schools are gonna go, we want you to pay us in December. Well, if you do that, it's the year you pay the money is the year you get to take the credit. So you've already paid their schooling for a year and you don't need any more education credit for let's just say 2017. And you pay their 2018 tuition on December 28th, you've just lost out on your 2018 credit because you paid it in the year before. Does everybody get that? Assuming that, let's just say that that student went to school just in the spring semester and you paid $5,000. Well, that was their 4th year. They graduate, and so you go, I don't get any money for that one. You just lost $2,500 because you were a good guy and paid the school early. So it's the year you pay the money. So if you pay the year, you want to pay for 2 or 3 years in a row, you can't do that. It has to be, if you pay it in the year 2017 for 18, you have to start in school the first 3 months. Okay, all of this, hopefully you guys have read this. This is all in there. What happens? Do you phase out? The lifetime learning credit is really high. The, the American Opportunities Credit is really high, between 80 and 90,000 for single people, 160 and 180,000. So if you make $150,000, you get the full American Opportunities Credit. When we go to the next page, we're going to see lifetime learning. It's way lower. Lifetime learning phases out between $57,000 and $67,000, and for married couples between $114 and $134. Okay, lifetime learning credit is 20% up to the first $10,000. So if you spent $10,000 for tuition, you could actually write off $2,000. But remember, for the first $4,000, you got to write off $2,500 in the American Opportunities. So this is not as good a deal. So if you only had $5,000 of tuition, you get to write off only $1,000, 20%. It's not as good a credit. But what's the difference? You get to have it no matter how many years you're in school. American Opportunities Credit, the first 4 years. The can you be a druggie? You can have all the drug convictions you want and use the lifetime learning credit. Do you have to be at least a half-time student? No. You can be anything. Okay?
Which one? The American Opportunity?
Lifetime learning.
Or lifetime learning, you don't have to be a full-time student.
No, you don't have to be. You have to be a half-time student for the American Opportunities Credit. For lifetime learning, you can just be anything.
What's considered half-time?
What's that?
What's it considered half-time, like?
Whatever full-time is. Let's just say full-time is considered.
14, right?
24 credits for the year.
How much? Oh,
24 credits.
per semester would be 12.
12.
So half-time would be 6. That's fairly easy bar to get to. But if you only took one class, you'd still get some credit for it. American Opportunities Credit, we said that you got it for tuition fees and including books and supplies, including even buying a computer for your school. It was part of your class. It was a requirement. Lifetime Learning, it's only tuition. That would be something that where they would ask, you kinda need to know this stuff. Okay, Child Tax Credit, one of the other ones, they're gonna ask you a bunch on this. And we are not gonna go too much, but they're gonna ask questions about due diligence. This is a big deal, I don't know about you guys, but I'm preaching to my employees, you gotta ask questions about education credit, we just went over, child tax credit, and earned income credit. It's a $525 fine per credit. So if you had one student and you didn't ask them any questions, such as you didn't ask his parents, did he really live there? And, oh no, well, he's living with his mom or living with his girlfriend or whatever. That could be $520, $520 or $1,560. That means that the IRS fines the tax preparer $1,500. Question?
Do you have a form that you have the?
Yes, and we have
To
questions.
make sure that you have documentation.
Most
Due diligence.
softwares make you answer the questions unless you just want to ignore them.
Okay.
And we're gonna go over that in a little bit. So, what are the rules for child tax credit? It went up until this year, it's been $1,000, okay? This year it doubled to $2,000. So what do you gotta be? That's just the child tax credit. The additional child tax credit is and it's a refundable credit. Child tax credit is not refundable. So if you don't owe any taxes, you don't get it. Additional child tax credit is the companion. Even if you don't owe any taxes, you get $1,400 per kid. It starts phasing out at lower income levels. $1,400 per kid, 3 kids, that's $4,200. You throw that onto your $15,000 income, and you get another $6,000 of earned income credit, and you're actually starting to get a refund, which is why we're having a problem with this. It's the money. Okay, so what are the rules? A qualifying child for, on page 189, son, daughter, brother, sister, or their descendant. That includes stepchild, foster child, adopted child. Adopted child is just your child. Okay? Half sister, half brother, niece, nephew, grandchild, all of these count. Everybody, hopefully you know this. Same thing is gonna apply, it applied to being a qualified child, what we went over in the first week, and it's gonna apply to earned income credit. Okay, for child tax credit, the child has to be under age 17 on December 31st. So if it's birthday, like my son, December 23rd, I got knocked out one year. That was rude. But it's what it is. Okay? Huh?
People do ask that question. But he's not 17 yet.
Okay. Okay, here we go. He has to be under the age 17. Did he provide half of his own support? Not many 16-year-olds do that. Okay. Live with the taxpayer for more than half the year, and you're considered living even if you were away in the hospital, away going to school. Not many kids in Hawaii go to the mainland to go to high school or junior high. But they do that on the East Coast. They send their kids to boarding school. Okay. Reformatory counts too. So if your kid's in trouble, you still get the county. Okay, the child is claimed as a dependent on the taxpayer's tax return. Was a U.S. citizen or a U.S. national? And not married and filed a joint tax return. Do you see anywhere in here where it says the child lived with the taxpayer for more than half the year? Yes.
It should have.
That didn't used to be a rule.
Mhm.
It could be you could, have a 8332 form, given the exemption to the other spouse, and the other spouse got the child tax credit before. And I've been trying to, the old rules have, maybe, I don't know if it changed this year, but I'm gonna go back and look that up to make sure. Okay, so, he has to be claimed as a dependent, he has to be a U.S. citizen, a U.S. national, or a resident alien. Everybody good with that? We're gonna get on another couple of pages, you gotta have a social security number. Even if you've done everything else, but you haven't gotten, because let's say you've gotten married and you lived in China for 6 months with your new wife and kid, and then you guys came over here, but the wife and child didn't get social security numbers. Now they have to get social security numbers by the filing date, or you file an extension and they get a 6 months extension. So if you've got somebody, I had somebody like this here. He's a longtime client. He just got married. His wife is from Thailand. She had a son that's 8 or 10. They came over. They didn't get their social security cards and everything by April. So I had them file an extension. They came back in here about a month ago, and everybody lived happily ever after. And it's because, okay, so the catch is, if you're getting close to April 15th, don't take a chance, oh, we're gonna get it any day now. Go ahead and file an extension. Okay, that's a personal opinion. Now, in the old days, your income for child tax credit was like $110,000 it started phasing out. Now, what is it? 400,000. Okay, 200,000 for everybody else. So, they may have that on the test, because a lot of this has changed this year. There's a new $500 non-refundable credit for kids that don't have social security numbers and aren't gonna get them, or their kids are over the age of 16 and they don't get the child tax credit. They get a new $500 credit. Okay, so for that $500 credit, they don't have to have a social security number. They have to have an I-10 or an A-10, which is an adoption credit.
So what does TCJA stand for?
Upside Job Act.
That's the new tax act.
Yes.
Soak the poor people, let the rich people get away with murder. That's personal opinion again.
You have to raise up to 400,000.
Yes, that means a lot of people that made over 100 grand didn't get child tax credit. Now they get it big time.
First time.
First time. Okay. Retirement savings credit. So there's a few rules about that. Retirement savings credit, if you have a low enough income and you put money into an IRA, a 401k, a Roth IRA, a thrift savings plan, anything like that, okay, you get to get a credit. There's, on the bottom of page 192, there's the amounts. Married filing joint, you gotta make under 38,000.
Will we ever come across that?
Not very, they might have one on there. I don't think they're gonna make you know the numbers, but they might. I suggest you do. what is it, so, first, you can't have taken money out of your IRA and put it in the same year. So let's say that I have an IRA or a 401k. I took out 10 grand out of my 401k at work because I changed jobs. Even though I might have put 5 grand into
And you
another IRA,
this-
I can't get the credit because I took out more money than I put in. What is the limit? I think it's a couple grand per person. 2,000 for the husband, 2,000 as the wife, if you got both of them. And what are the other rules? You gotta be at least 18. You can't be anybody's dependent, and you can't be a full-time student. That might be the question they're gonna ask on this. If they really wanna be tricky, they ask you these numbers. 50% if you make under 38,000 and you're married, filing joint. 20% if you make under 41,000. 10% if you make under 63,000. And for single and head of household, they got different numbers. I can't imagine they're gonna require you to know all that. I just can't remember if there is anything like, that's kinda like tricky. Credit for the elderly, you have to be either over 65 or retired before the close of the tax year due to total and permanent disability. If so, you can get 15% times your initial base amount. I'm gonna just let you read this because I could spend 10 minutes going over this and still, all I'll do is confuse you and me. You very seldom get much. What you need to know for the credit for the elderly and disabled, almost nobody gets it in real life. Okay, but what it is, if you can get a credit of up to $5,000, but $7,000 if you're a married filing joint, but you have to subtract your Social Security. And there's limits on income, 17,500, and Social Security. I went through it and it was confusing to me just now, and I've done it before. Okay, let's go to adoption credit. This is one they're gonna have. So, 13,810. That's the maximum amount you get per child. Okay, so I spend $30,000 to adopt a child. That better be a good child. Okay, so my company has a plan that says they'll give me $13,810 off of my wages as non-taxable, and they'll pay the first $13,000. As long as I don't use the same money for both of them, I could take $13,810 from my wages, and they would pay the expenses, and I don't have to count that as taxable income. So let's say that I had 100 grand, I get to subtract the 13,810, we'll say, and they would pay that amount. I don't have to pay tax on it.
I have a question. So say you had 100 grand, is that what it's gonna be on your W-2?
Well, it would probably be 100 grand minus the 13,810. Then I pay the expenses of 30,000, so I get to write off 13,810 on my tax return as the adoption credit. What I can't use is the same money. So if I only had $15,000 of this, okay? If my expenses were only 15,000, I couldn't do this. If my expenses were only 5,000, I could only use the 5,000. I couldn't double dip.
Oh, because you had 30,000, then you could do that.
There's an exception. You have a child with special needs. Then you get to take the whole 13,800, even though you didn't spend the money for it. But you were doing a really good thing by taking a kid with special needs. Okay? So what does the child have to be? Under age 18? And, what kind of things? Lawyers, doctors, court cost, attorney fees, any kind of flying an airplane over to get your kid in some foreign country. That would count. Staying there, getting your kid, all that would be part of it. What the things you can't are costs associated with surrogate parenting. You left the kid with somebody for 6 months, rotten person. Expenses in violation of state and federal law, you kidnap the kid, not good. This is what I just happened to have recently. This really happened. We had somebody that, first of all, English is a second language, they barely spoke English. The guy adopted his sister's grandchild, not his wife's child. But on the adoption papers, they checked the wrong box. So, the IRS says, send in all the paperwork. They send out all the paperwork. It's got the wrong box. It says, you're the parent. He goes, no, I'm not the parent. We had to go all the way back through the court, get another corrected paper. And the court guy goes, it doesn't matter, just go ahead. Well, it does matter to the IRS. And we're actually still fighting that case. So we sent all this stuff to the IRS, and hopefully it'll all straighten itself out. The other thing is, the person that checked the box that says special needs, he wasn't a special needs child. So they were trying to give him too much, they were trying to give him the whole credit. He deserved to get the $2,500 that he paid a lawyer, $2,250 that he paid a lawyer. So we've now sent all this, straightened it all out, and hopefully sometime in the future the IRS will send it back. Okay, I almost got it straightened out, but she goes, send me the lawyer's invoice. Well, it took a month to get that because the lawyer was a jerk. On the other side of that, he was doing this pro bono for poor people, and he could probably care less. Okay, so assuming that you don't have a special needs child, what happens to special needs? You get the whole amount.
And what's the whole amount?
$13,810. You need to know that. Okay? And all of this stuff, you're going to read this and do the questions, hopefully. You're not just, you don't get the whole thing if you just listen to me. Just saying. Residential mortgage interest credit. So, what's that? So, if you have a mortgage, there's a special credit. It can be 10%, 20%, 30%. They say up to 50%. In Hawaii, we only have 20%. I've never seen any other number. So what is this mortgage certificate? It's, I think it's through a state agency. You can, low-income people can apply to buy a home, and they get a credit of 20% of their mortgage interest. So instead of just writing off your mortgage interest on Schedule A, 20% of it's a credit against your taxes, which is way better. Especially now that everybody's got higher standard deductions, they're not going to be able to use their mortgage interest as much as they used to. So, okay, here we go. If the rate exceeds 20%, the credit is limited to $2,000 per year. So what does that mean? You've got a 20% rate or 30%, and your mortgage interest is $10,000. Okay, so mortgage interest $10,000, and you, let's just say 25% rate. So you could write off $2,500, as a straight credit against your taxes. That's a really good deal, except that it says if your rate is above 20%, you're limited to $2,000. Okay, so even though it says 2,500, you can't write off but 2,000. But if it exceeds 20%, so in a Y, we're not limited like that because our rate doesn't exceed 20%. That's a, or at least as far as I know. How long can you carry this forward? Let's say that you had a $2,500 credit, but your taxes were only $2,300. You'd get to carry that 200 over to next year, and it would add to your, if you had the exact same everything, 2,500, you'd have 2,700. If your taxes were a little higher, you could write that off, or you could carry it forward for 3 years.
How do you write it off the next year? What
Carries forward.
There's a form. Does it say the form number? So it's like a 53 something, 83, you got it? You see it somewhere? Yeah.
It might be wrong.
It is, it's a numbered form. And my software, you just go mortgage credit, and the form pops up. Cause I can't remember the number. If you have to, you try to remember all the numbers you can, but you can't remember all the numbers of all the forms, all these amounts that are limitations. You get as much as you can. Minimum tax credit, it's part of, like if you have AMT and you had AMT tax, the next year, if you're below the AMT threshold, you can get some of that credit back on certain cases. It used to be mostly on things like accelerated depreciation. I don't see. Okay. Now we're going to my favorite credit, earned income credit. Okay, earned income credit. You're gonna get asked a lot about it. And then when we finish with it, we're gonna go over due diligence, because education credit, child tax credit, earned income credit, there's a $520 fine per each one of those per person if you don't follow the rules. Okay, so earned income credit, you gotta know, you get an earned income credit if you're between the age of 25 and 64, for yourself, if your income is low enough. Otherwise, you can get earned income credit for any qualifying child that fits the rules. Think a qualifying child without the support test. And because everybody remember qualified child from chapter 1, child tax credit from this chapter 6. They're almost, the rules are the same. So, it starts off, it has to be your relationship test. Son, daughter, brother, sister, or their descendants. That includes stepson, foster child, grandchild, niece, nephew, the child of your niece and nephew. So your sister has a grandchild, that would be your niece and nephew's child. Are they still niece and nephew? Whatever they are, they still qualify. They're a descendant of your child, your son, daughter, brother, or sister.
For earned income credit and
For earned income credit, for a qualifying child on your tax return as a dependent, or for child tax credit. All of them are the same. The one thing that's different on earned income credit is there is no support test. On dependency and child tax credit, the child cannot support themselves. That doesn't apply to earned income credit. So you have an 18-year-old kid, okay? lives at home, your child. The kid makes $30,000 working construction right out of high school. He's still only 18. He's under the age of 19. He's your child. He lives with you. He can't be your dependent, but he qualifies for earned income credit.
How's that? He qualifies for earned income credit, but you're not claiming him.
You're claiming him for earned income credit.
Oh, but he's not your dependent.
He's not your dependent. He goes on the EIC form. Does everybody see how, okay? So what are the rules for earned income credit? Child tax credit, dependency, has to be relationship, age. What are the age tests? Has to be under the age of 19 and younger than you. Under the age of 24, a full-time student and younger than you. Or totally and permanently disabled, any age, and doesn't have to be younger than you. The younger than you is new about 2 or 3 years ago. You gotta watch that one. So it used to be, you could have a kid that was 19 years old working, and his big brother lived with him, okay? And his big brother was a full-time student. That 19-year-old could claim the 22-year-old brother. Not anymore. Or we have a lot of kids like, same thing for sisters. Everybody lives in the same household, right? The mother doesn't work or doesn't make much money, so they want to let one of the kids claim one of the other kids. One of the rules now is they got to be younger than you. I wonder what we do with my identical twins. They're only 20 minutes apart. There's no way to prove, why I'm saying, there's no way to prove who's the oldest.
Documentation of when you were born. The
There's
time.
no way to prove which one's first. That I know of. I don't think we have anything that says, 7:22 in the evening. The other says 7:42 in the evening. Same date. We got the same date. Okay, so what is the third one? Has to be a residence. So 1, relationship, 2 is age, 3 is residency. They have to live with you for more than half the year, right? If they don't live with you for more than half a year, you can't claim them. We get this all the time. We get either divorced or people that have kids together, they got joint custody. And they go, I take the child this year, they take it next year. Well, you gotta go, well, who's the child lives with the most? I don't know. Or they start telling you an answer and you better explain, this is the rule. It's who the child lives with spends the most nights out of a year. What happens if you can't prove it? If only one person claims it, most likely, and it's really joint custody, and the child is going back and forth every night, the IRS won't question it. But if the IRS questions it, you've got to prove the child spent more than 183 nights with you. And there's, unless you have calendars, you can write all that down.
Check in,
Huh?
check in.
Fingerprint. Okay, so what are the other rules? Okay, you need to know the individual. You must have, if you have an I-10, you're disqualified. Remember, you have to have a social security number for a child tax credit, earned income credit, but you can have an I-10 for a dependency. You can have an I-10 for that $500 credit. Okay. Individual is not eligible for EIC. He does not include his or her correct social security number. If you have married filing separately, you can't have EIC. The credit is not available for taxpayers who fraudulently claim the EIC. So, in the past 2 years ago, you claimed your cousin for EIC, and your cousin didn't really live with you, he lived with his parents. But you claimed it and got caught. So the IRS says that we're going to deny you earned income credit for 2 years or 10 years. If they say you committed fraud, they can take away EIC for 10 years. Even if now you got your own kids. Too bad you cheated.
We have one client from Minnesota that has it from Hilton with a tipping way down. So she's one of those that were eligible for EIC. They gave her like
10 years?
So I worked with IRS and let her because, we didn't pay her taxes then. So then when she came to us and we started denying, so I was wondering why, so we called the IRS, we went to the advocate, and then they finally said okay.
Okay, but that's a crime. If you get somebody caught in that, that's a mess. Okay. What happens if you have the child claimed by 2 people? Like I was saying, if only one person is claiming that child, a lot of times it'll go through. But if you're claiming your niece or nephew now, the IRS is getting very picky. They want you to go, where are the parents? And as for you, you're gonna have to ask that. That's part of your due diligence. And if you go, the parents, oh, they just live down the street, wrong answer. Unless you can prove the child lives with you, that's not gonna work very well for you. Okay, so what happens if you have 2 people claiming the same child? If both of you file tax returns with that same child, the IRS is gonna send both of you letters saying prove it. Okay, so what are the rules? If 2 parents live apart, they were never married or they're divorced, and both of them claim the same child, the IRS is gonna get one of them. So how do you determine? You need to talk to that client and make sure they understand if both of you, and we have it happen every year. Somebody comes in, files a tax return, says the child lives with me, then in about 10 minutes later, we come back before they get out of the office, you go, hold on, this came back, it was rejected by the IRS, somebody else has claimed that child. And they go, my rotten mother-in-law or whoever. And then we have to decide whether you're gonna go through all the trouble to actually get credit. We actually had a guy yesterday that exact same thing happened. His girlfriend, I guess, or somebody, they've been switching off with the kids. This year she goes, oops, I'm sorry, I claimed both of them. And he just let it go. So it changed his taxes a bunch. He went from head of household to single, and instead of getting $2,000 for child tax credit or any earned income credit, he got zilch. So he owed money instead of getting money back.
And the kids live with him the most?
That's debatable. So, as we go into it, we went into all this to talk to him about it, saying, but can you prove the child lived with you? Well, no. And now the child has moved with the mother to Eva Beach, and so now there's no question. So he let it go. And it could have been, it was he that was mistaken about how much the child actually spent with him. I don't know. My son was doing the tax return, I was just listening on the side. Okay. Okay, earned income credit, what is it based on? Your earned income. If your earned income is too high, you don't get it. Excuse me, if your adjusted gross income or earned income is too high, you don't get it. So it's, the computer's doing this now, but you take the earned income, the adjusted gross income, calculate it with both of them, and whichever gives you the lower earned income credit, that's what you go with. Now the computers do the worksheet. One of the things we're getting ready to find out is that that's a requirement that you keep that worksheet.
What do you compare? The adjusted gross
The
income?
earned income, okay, so earned income, wages, salaries, tips, net income from self-employment, income from a partnership would count. Income from a S corporation wouldn't. Unemployment wouldn't. Alimony wouldn't. Interest dividends would not count. Anything under other income probably wouldn't count.
Okay, so you compare the earned income
With the total income.
with the total adjusted gross income?
Uh-huh. But it works kind of like this. It's a bell curve, sort of. So if your income is down here at 3,000 or 4,000, as you go up, you get more earned income credit. And so between here and here, maybe between 6,000 or 8,000 and 14,000 or 15,000, depending on the number of kids, you get the maximum amount of earned income credit. As you get down here to about 30 or 40,000, depending on the number of kids, where you're married or single, you get less. So if you only made 3,000 or 4,000, you just get a little. More kids, you get more. As you go up, you get more and more and more. So people will every now and then go, what is the maximum? Where do I get the most earned income credit? Do not, this is my personal opinion, sit there and go through this with them and before they tell you about their income, especially if they're self-employed. It doesn't matter if they've got W-2s, they can't really fake that. But if they're self-employed, they somehow want to make it hit the right amounts, and that's illegal. Okay, so on page 198, there's the calculate EIC. There's the phase-out amounts. So if you got 3 or more kids, you can make out, and you're a married joint filers, you can make 54,000, almost 55,000 before you phase out of earned income credit. If you've got 0 kids, you start phasing out at before $8,500. That's no good. And that's the top end. Okay, so let's say that now we've got all of our guys, they've come in, they've told you about their kids, they said that this is their income, and we just got through doing their education credit, their child tax credit, their earned income credit. We need to ask them these questions. If you don't follow the due diligence rules, you're gonna be in trouble. And I guarantee they are gonna ask you the due diligence rules. First, the penalty is a $520 penalty for any return or claim for refund for each failure to comply with the 4 due diligence. So that's at least $1,500 if you hit all 3. Okay, so there's 4 different components.
When did they take your license away? Like how many months?
They can.
I know 2 people that got fined. One of them was $32,000, the other was $24,000 in Hawaii about 5 years ago. $32,000 fine. She was doing a lot of tax returns, but she was just typing as fast as she could, wasn't asking any nosy questions.
One of them died already.
Yeah. One of them beat the IRS out of it. She died before they got
Before
all
she
the
could
money
pay.
back. Huh?
Before she could pay.
Yeah. But that also means she missed her bonus because the company she worked for was giving them big bonuses for that. Okay. So what happens, let's make sure, okay, if 2 people claim the same child, you have tiebreaker rules. If only one of them claims it, that one wins. There's no more, you know, pretty much. But a tiebreaker rule, first, if two parents try to claim the same child, it's who did the child live with the most? Okay? If the child lived with both of the parents the same number of days, let's just say all year, then it's who the parent that made the most money, highest AGI. What would that be? Two unmarried parents that would be. Because if you were married, you couldn't file separately and either one of you get earned income credit, right? Nobody gets earned income credit if you're married filing separately. Nobody gets earned income credit if you all don't have Social Security numbers. Or if you were a non-resident alien for any part of the year. Okay? So what are they? There's the four due diligence are the new expanded regulation clarify the requirements and performance standards for the knowledge requirement. Completion of an 8867. That's the checklist. Determine that the taxpayer is eligible to claim the EIC for the number of children. Determine that the child lived with the taxpayer for over half the year. Explain the tiebreaker rules, and you have to go through on all, I know my software and most softwares, they have all this. You can't get through the software and qualify for electronic filing without doing this. If you mail the tax return in and you don't put this form on there, the form 8867, that's an automatic $520 fine. Okay? Computation of the credit. Your software does it, but you gotta complete the application EIC worksheet associated with it, okay? And all related forms. You have to keep that for 3 years also. So it calculates, remember I was saying you get the lower of earned income or taxable adjusted gross income, whichever gives you the lower credit is the one you use. Well, you have to calculate that on a computer and keep a record of it. If anybody's still doing this by hand, I don't know anybody that does taxes by hand much anymore. Okay? So you have to have a completed Form 8867, completion of the credit, you gotta complete the worksheets. Knowledge, you have to interview the taxpayer, ask questions, and document the taxpayer's responses. And review the information to determine the taxpayer is eligible. So you can't take, if that guy goes to you and go, yeah, this is my niece. And you go, okay, type in niece, what's the Social Security number? He gives it to you on a piece of paper with her name and her birthday. And you accept that and don't ask any questions. You've just cost yourself a $520 fine. Actually, probably a couple of them because you're going to get child tax credit for one and earned income credit for the other. Usually you don't get all three. Not many people in college for the education credit are under age 17. But I guess there could be. All right, so knowledge. You can't ignore the implication of information. So if the guy says to you, this is my niece, and you go, does she live with you? Yes. Where do the parents live? They live a couple blocks over. And you accept that? That's a $520 fine, pretty much. And you need to document why do they live 2 blocks over and they don't take care of their own kid. And then you need to say, what proof have you got that child lives with you? You go, well, this child's in school. Is your name on the school record as the emergency contact? No, his parents are. Wrong answer. Who pays for the medical? The parent. You gotta ask all these, and if they keep answering, they have no proof, I personally don't think you ought to do this. Yeah, just go, good luck, H&R Block's over here. Just kidding. I don't have, the last couple of years, every year I had some H&R Block people in, so I couldn't, make fun of them. Okay, so knowledge, document, you have to document. What does that mean? You have to either have some documentations you make, scan, or make copies of, you keep in a file, or you have to ask questions. I ask, where is the parents? And he goes, oh, the parents live in Marshall Islands. They live in the Philippines. They live in Tokyo, something. But they better not be 2 blocks away. I ask, is your name on the school emergency contact list? Yes. He said it was on the emergency contact list. Okay, what proof have you got that the child lives with you? Do you have him on your rental contract? No, why not? I don't have a rental contract. That's a good answer, but I ask. Everybody getting the idea? Document, document, document. Okay. Then record retention. What do you gotta do? You gotta keep all these records. Most of it, you're gonna keep, does everybody on your computer programs, there's a place for you to write all this stuff down. And then you back up your computer and make sure you have some way to back this up that you're not gonna lose this. 3 or 4 years ago, there was a lady down in New Orleans that was a reputable lady. She had a fire in her building. All of her records were gone. She had no backup off-site. The IRS came in and asked her for it. She lost it. They said that's a so many $1,000 fine. She was out of business because she had no proof. You know that you're always supposed to have records of all the tax returns you've done, or there's an alternative. You can have a list of who you did, when you did it, and that kind of stuff. Generally, you need a list of all your tax returns for your own sake. And if you're electronic filing, you need to have a copy of your W-2s, 1099-Rs, other things that would have withholding, unemployment, or whatever. Okay? That's not part of today's class, but that is a question that you're gonna get. And how long do you need to keep it? More than 3 years, usually 4 is what I say. That might not be the correct answer though. Okay, record retention. What do you have to have? You have to keep that 8867. That was number 1. That is where all the questions are gonna be. Where you're gonna go, is this the father or mother? Yes or no? Where is the father or mother? Father lives in California. Great. So the kid goes to school at Farrington High School, the dad's in California, and you're the mom, you're in pretty good ground already. Okay, so you gotta keep all the records. You gotta keep a copy of the 8879. You gotta keep a copy of proof that they give you. Oh, if they don't give you the proof, you need to ask. If the IRS requests it, can you give me a copy of birth certificate, social security cards, things like that? That's a question you need to ask. If you don't ask it, you could be in jeopardy of getting fined because you didn't ask. Not asking the questions is also a reason to get fined. So what happens if they go, I don't have the birth certificate, but I can get it. I don't have the social security card, I can get it. I don't have the rent contract, but this child is on the rent contract. A lot of times they're not. What you really have a problem with is that what is it called? District exemption? They want to go to one school, so they say they're living with grandma so they can get into this school. But they're not living with grandma, they're living with you. Then you got a problem. Okay, everybody good with this so far? Okay, records must be kept 3 years from the latest of the following due dates. There's your whole list of them. Retention of a copy of the Social Security card for the taxpayer and each qualifying child is not required. Same thing with birth certificates, but they're not required, but you need to be able to get them, and you need to ask, do you have birth certificates? Can you get them? That kind of stuff. Okay, premium tax credit, what is that? If you got ACA, Obamacare, you can, if you have Obamacare and you make less income than you're telling them, you might get a premium tax credit, extra money. Everybody familiar with that? Everybody familiar with what a 1095A form? If you have a 1099A form, you have to put that in the computer and fill it out. And it's gonna determine whether, if you claimed, I only made 10 grand and you make 20, then you're probably gonna owe ACA some money back. On the other hand, if I go, I make 30 grand, but this year you only made 15 and you got 3 or 4 kids, then they're gonna give you extra money. They're gonna give you, what's it called? Premium tax credit. We're gonna these poverty line numbers don't apply to a Y. I don't know if they're gonna give them to you. But Alaska and Hawaii have our own set of numbers. Okay, this is just read it. You might get something. Health coverage tax credit. I've never seen anything, but just read it just in case you have a general idea. Employer credit for paid family medical leave. The employer could get a credit. This is never in there either, but just kind of have a general idea how. Estimated tax payments. When do we have to make estimated tax payments, guys? If they don't pay enough taxes. What happened last year? After they passed the new tax law, President Trump went to the IRS, the other guy that was ahead, and told him that I want you to reduce withholding on everybody. And he goes, no, this isn't gonna apply to everybody. Well, he said, I don't care, either you do what I tell you or you're fired. So the guy reduced everybody's withholding. Well, some of the people, that didn't work out so well for them. They ended up owing money this year. Others, they did okay, because they fit just the right pukas. Yeah, they had a bunch of kids under the age of 17. Okay, so estimated tax payments. When are you supposed to pay them? Every 3 months, April 15th, June 15th, September 15th, January 15th. These are not exactly 3 months apart. You just gotta know these. What do you have to pay? You owe over $1,000 in taxes, then you probably should have been paying estimated tax payments. Okay? If you paid at least 100% of the prior year, or 90% of the taxes you owe for this year, you don't owe estimated tax payments. If you make over 150, it goes, instead of 100, it goes up to 110. If you didn't have any tax liability in a prior year, you don't owe it. Fishermen and foremen, just go ahead and read this. They sometimes have a question about that. So what is it? You gotta make 2/3 of your income from being a fisherman or foreman, or you don't get to do this. What do they get to do? They can either make an installment agreement, they only need to do one by January 15th of the following year, or they can wait and pay all of their taxes and file their tax returns by March 1st. Okay? And they don't have to pay any estimated. Why do they do that? Fishermen and foremen, farmers don't really know what kind of income they're gonna make until the harvest. Or, in case somebody happens to get in a trade war, and the other side says, we're not gonna take any farm products from you guys. Okay, and we've already talked about if you had Social Security taken out from two different companies and your income is above the 128,400, you might have had excess Social Security taken out. If so, you get that back on your tax return. It's on a line, a couple of lines down from withholding. Okay, claims for refund, you need to know this. Okay, what is the rule for claims for refund? You either, one, have to amend your tax return, claim that refund 3 years from from April 15th or from the extension due date, October 15th. Two, if you want to get the money back, you can file your tax return 10 years late. You don't get any money back, but if you owed a lot of money, you might want to do that to reduce the amount you owe. You don't get any back. The second one is, let's say that 4 years after you should have filed, you pay the government $2,000. So it's either 3 years from when you should have filed, April 15th, 3 years later, or 2 years from when you actually paid the money. So if you were supposed to get a $4,000 refund, but you waited too long, you might get the $2,000 you paid late. Everybody pretty much got that? Okay? We're going, now, the first question or two I did, that was so convoluted, it's unbelievable. They're not gonna have that tough of questions. I'm gonna run to the restroom real quick. We're gonna have a 5-minute break. The next chapter is really short compared to this one.
What's the next chapter?
Basis, but it's also hard. And then the next week is gonna be more, and I'm gonna either print everything out and give it to you next week, or I may just email everything to you beforehand so you can have it before you do the chapters. Does anybody else want to take a break? You guys good? Okay. Up for years, they did a lot of work on basis. Last year, they didn't have quite as much as they used to. But you need to know basis. We're gonna go over it for the next couple of weeks. Okay, so, cost plus the things that are associated with cost, like here at the bottom of page 219, all the things that you add into your cost when you buy it. Okay? That's your beginning basis. Plus adjustments. What would that be? You You buy a truck for work and you add racks on it, or you add shelves into the truck, or you put super duper tires or something. You did adjustments. Or you had a house and you added a new roof, a new garage, all kinds of stuff. New kitchen, new bathroom, you carpet the whole thing, you do all new appliances, whatever. Okay, then you minus depreciation. And from that, now you've got your basis.